guys, today I will be talking about something important that affects many people worldwide, which is debt management. First of all, we will learn about what debt management means and why it's important. Then we will talk about different types of loans like credit cards and personal loans. And what do we mean by secured or unsecured? We will also talk about various strategies for managing loans, including budgeting, consolidating loans, settling loans, and seeking credit counseling. Lastly, we will also discuss the consequences of poor debt management. Now, before we start, please note that this video is only for educational purpose to explain you what debt management means. These days, we often borrow money to buy things we need. Sometimes taking a loan can be useful, like buying a house or starting a new business. But if we don't manage our loans properly, it can become a big problem for us. Debt management means handling your loans in a way that doesn't stress you out. It's a process that helps you stay in control of your loans, so it doesn't become a problem for you. Managing your loans is really important because it can stop you from having financial troubles. When you borrow too much money, it can be tough to pay all your bills and you might feel stressed out. But if you organize your loans and make a plan to pay it off, you can avoid missing payments or paying extra interest or penalties. Your credit score is also really important. If you have too much loans and can't keep up with the payments, it can hurt your credit score. But if you manage your loans well, you can improve your credit score and be able to get loans at much lower interest rates in future. By managing your loans, you can take control of your money and make sure you have enough to do the things you want to do. Let's start by understanding what debt is and the different types of loans. Debt is a financial term that we hear a lot about, but might not fully understand. In simple terms, debt is money that you owe to someone. It can be money that you borrowed for a specific purpose or money that you have to pay for a purchase you made on credit. It can be in the form of credit card loans, educational loans, auto loans, home loans, or personal loans. Each type of loan has different terms, interest rates, and repayment schedules, which can affect how you pay it off. Credit card loan is one of the most common type of debt. It's easy to use a credit card to buy something, but it can be challenging to pay it off. Credit card companies typically charge high interest rates and you only pay the minimum payment each month. It can take a long time to pay off the balance. Educational loans are another type of loan that many people have. They are usually used to pay for college education. And while they can be helpful in getting education, if they are not managed properly, they can also be challenging to pay off. Auto loans are another type of loan that many people commonly have. They are usually used to finance a vehicle purchase, and like other types of loans, they have interest rates and repayment schedules that need to be managed. Home loans are another significant type of loan that many people have. They are used to finance a home purchase and typically have longer repayment schedules. Home loans can be either fixed rate or floating rate, and it's important to understand the terms of the loan before signing up for one. Personal loans are another type of loan that people can take out. They are usually used for large purchases or unexpected expenses, and they have different terms and interest rates depending upon the bank. There are two types of debt, secured and unsecured. Secured loan means that you have to give something valuable, like a car or a house, to the lender as security. If you can't pay off the debt, the lender can take away your valuable thing. Unsecured loan doesn't need you to give any valuable thing as security, but you might have to pay higher interest charges. Not all loans are same. Some type of loans have different interest rates and payment schedules. Credit card, for example, usually have higher interest rates than any other loans. Educational loans may have different payment options and can have fixed or floating interest rate. Home loans may have lower interest rates than other loans, but it may take you longer to pay them off. It is important to understand the terms and conditions of each loan and to manage your debt effectively. It can help you prioritize loan payments, negotiate with creditors, and avoid taking an additional loan. By understanding your loans, you can develop a repayment plan that works for your financial situation and goals. Creating a budget is an important step in effective debt management because it helps you get a clear picture of your financial situation. To create a budget, you need to identify your sources of income and your expenses, including your loan payments. You can then look for ways to cut back on your expenses, such as reducing your discretionary spending or negotiating with service providers for lower rates. It's important to be realistic and flexible with your budget, as unexpected expenses or changes in income can occur. Sticking to your budget can be challenging, but there are strategies you can use, such as setting specific goals, tracking your spending, and seeking support from professional advisors. By sticking to your budget, you can reduce your loans, improve your credit score, and achieve financial stability. With well-crafted budget, you can reduce your loans and improve your overall financial situation. I explained budgeting in detail in my previous YouTube video, and I would suggest you to go through it in detail. Another important aspect of debt management is debt consolidation. This involves combining all of your loans into a single loan with a lower interest rate. This can help you save money on interest payments and make it easier to keep track of your loans. Debt consolidation is a financial strategy that involves taking out a new loan to pay off multiple loans. The new loan usually has a lower interest rate than the existing loans, which means that you may save money on interest payments over time. Instead of having to keep track of multiple loans and their payment schedules, you only have to make one payment each month. Debt consolidation can be used for various types of loans, such as credit card loans, personal loans, medical bills, and even some types of educational loans. By consolidating these loans, you may be able to lower your monthly payments and make them more manageable. One of the benefits of debt consolidation is that it can simplify your finances. Instead of having to remember multiple payment due dates and amounts, you only have to remember one payment. Additionally, if you can secure a lower interest rate with the new loan, you may be able to save money on your interest payments. To consolidate your loans, you will need to apply for a new loan from a lender. You will need to provide information about your existing loans and your financial situation, such as your income, expenses, and credit score. If you are approved for the new loan, the new lender will pay off your existing loans and you will start making payments on the new loan. However, debt consolidation also has some risks and drawbacks. One risk is that you are not able to make the payments on the new loan. You may end up in a worse financial situation than before. Additionally, some debt consolidation loans may have fees or high interest rates, which could end up costing you more in the long run. It's important to research different lenders and loan options before committing to a debt consolidation strategy. Overall, debt consolidation can be a helpful strategy for managing your loans and simplifying your finances. By understanding the benefits and risks of debt consolidation, you can make an informed decisions about whether it's the right choice for you or not. If you are struggling to make your debt payments, you may want to consider debt settlement. This involves negotiating with your creditors to reduce the amount of loans you have. While this can be a difficult process, it can help you get out of loans more quickly. Debt settlement is a way to resolve your outstanding loans by negotiating with your creditors to pay off a portion of what you have. Debt settlement companies may negotiate with your creditors on your behalf, and if an agreement is reached, you will pay the creditor a lump sum amount that is less than the total amount. The remaining loan is typically forgiven or written off by the creditor. One of the benefits of debt settlement is that it can help you get out of loans faster and at a lower cost. It can also be a good option if you are struggling to make your monthly payments. However, debt settlement also has some drawbacks. It can negatively impact your credit score. Additionally, there is no guarantee that your creditors will agree to a settlement, and debt settlement companies may charge high fees for their services. If you decide to work with a debt settlement company, it's important to choose a reputed company and read the terms and conditions carefully. Be sure to understand the fees involved and the potential impact on your credit score. It's important to carefully consider the pros and cons of debt settlement and explore alternative options before deciding if it's right for you. Debt settlement should be considered as a last resort option only when all other options are exhausted. Credit counseling is another option for managing your loans. This involves working with a professional counselor to develop a debt management plan that is tailored to your specific needs. The counselor can help you identify areas where you can cut back on expenses, negotiate with creditors on your behalf, and help you develop a plan for paying off your loans over time. Credit counseling is a service that helps people manage their loans and improve their financial situation. Credit counseling agencies work with individuals to help them understand their financial situation, including their income, expenses, and loans. They offer guidance and advice on how to manage their finances and create a plan to get out of loans. The role of a credit counselor is to assess your financial situation, understand your loans, and develop a plan to help you manage your loans. They work with you to create a budget, negotiate with your creditors to reduce your interest rates or fees, and provide education and support to help you make better financial decisions. Credit counseling can help with debt management by providing a range of services, including debt management plans, financial education, and credit report analysis. Debt management plans are designed to help you pay off your loans by consolidating them into a single monthly payment that is more manageable for you. A credit counselor can also work with your creditors to negotiate lower interest rates, which can help you pay off your debts faster. Credit counseling is different from debt settlement in that credit counseling agencies do not negotiate your loans for you or promise to settle your loans for less. Instead, credit counseling focuses on helping you manage your loans by creating a plan that works for your unique financial situation. Credit counseling can be a helpful resource for individuals struggling with their loans. It can provide valuable guidance and support to help you manage your finances, create a plan to get off your debt, and make better financial decisions in the future. It is important to understand the differences between credit counseling and debt settlement to determine which option is best for your situation. Credit counseling can also be an effective way to avoid bankruptcy and achieve long-term financial stability. Having an emergency fund is an important part of debt management. When you have loans, unexpected expenses can make it even harder to keep up with your loan payments and dig yourself out of your debt. That's where an emergency fund comes in. An emergency fund is a pot of money set aside specifically for unexpected expenses, such as car repairs or medical bills. When you have an emergency fund, you have money set aside to cover these expenses, which can help you avoid taking on more loans to pay for them. When you are working on paying off your loans, it can be tempting to pull all of your extra money towards paying down your loans as quickly as possible. However, it's important to also set aside some money for your emergency fund. This way, you have a cushion to fall back on if something unexpected comes up. To build your emergency fund while also paying off loans, you can start by setting a goal for how much you want to save, such as 3 to 6 months worth of living expenses. Then you can work on setting aside a small amount of money each month towards your emergency fund, while also making your regular loan payments. While it may take some time to build up your emergency fund, it's important to stick with it. Having an emergency fund can provide peace of mind and protect you from taking on new debt in case of unexpected expenses. By including building an emergency fund as part of your debt management plan, you can work towards a more secure financial future. Negotiating with your creditors can be an effective way to reduce your loans and improve your financial situation. Before negotiating, it's important to gather all relevant information about your loans, including the total amount, the interest rate, and the payment terms. You can then contact your creditors to explain your financial situation and request a reduction in interest rates and a payment plan that works for you. Be prepared to provide documentation of your income and expenses, as well as any circumstances that may be affecting your ability to pay. While not all creditors may be willing to negotiate, it's worth exploring the option as it can potentially save you money and reduce stress. When you're already in debt, it's important to avoid taking on additional loans. This can be challenging, but it's an important part of effective debt management. One way to avoid additional loans is to create a budget and stick to it. This means tracking your income and expenses and making sure you are not spending more than what you are earning. If you have money left over after paying all your expenses and making your loan payments, you can put it towards your emergency fund or other financial goals. It's also important to avoid using credit cards for unnecessary purchases. Instead, try to pay for things with cash or a debit card. If you do need to use a credit card, try to pay off the balance in full each month to avoid accumulating more loan. By avoiding additional debt, you can focus on paying off your existing debt and improving your financial situation. It takes discipline and commitment to sticking to your budget, but it's an important part of effective debt management plan. Staying motivated is an important part of managing your loans. Managing your loans can be a long and challenging process, and it's easy to feel discouraged. That's why it's important to stay motivated. When you are motivated, you are more likely to stick to your budget, make extra payments towards your loans, and avoid making additional purchases on credit. There are several strategies you can use to stay motivated, like managing your loans, like setting realistic and achievable goals is an excellent way to stay motivated. Break your debt payment goals into smaller milestones, such as paying off a certain amount each month. Don't forget to celebrate the small victories, whether it's paying off a credit card balance or sticking to your budget for a week. Each small victory is a step towards your larger goal. Celebrate your successes, no matter how small they are, and use them as a motivation tool to keep going. Staying motivated is an important part of managing your loans. Finally, it is important to remember that debt management is a long-term process. You may not see results immediately, but with dedication and hard work, you can get out of debt and achieve financial freedom. It is important to stay focused on your goals and to stay motivated even when the going gets tough. Now let's talk about some of the potential negative consequences of not managing your loans properly. If you have a lot of loans and are only making the minimum payments each month, you could end up paying a lot in interest over time. This can add up quickly and make it even harder to pay off your loans in the long run. As I mentioned earlier, carrying too much loans and falling behind on payments can damage your credit score. This can make it harder to get approved for credit in the future. If you don't pay back what you borrow for a long time, the people you borrowed money from may take you to court. This can result in them taking some of your paycheck, putting a claim on your property, or other very bad outcomes. Poor debt management can lead to financial stress, anxiety, and decreased quality of life. This can be particularly true for those struggling to make payments on high interest debt. Bankruptcy can be a consequence of poor debt management, which can have long-term consequences on credit score and financial well-being. It can take several years to recover from a bankruptcy and may limit your future borrowing options. In conclusion, debt management is an important aspect of personal finance. It can help you avoid financial difficulties, reduce your stress and anxiety, and achieve financial freedom. By creating a budget, consolidating your debts, considering debt settlement or credit counseling, and staying focused on your goals, you can manage your loans effectively and improve your financial situation over time. It's important to carefully consider your financial situation and goals when developing a debt management plan. Remember that debt management is a journey, and it's important to stay disciplined and focused on your goals. With persistence and dedication, you can achieve financial stability and live a fulfilling life. Hope you like the content and would share it with your family and friends. I hope you will get some benefit out of this. Please share your feedback in the comment section and I will be happy to read all the comments. Thank you.